Hello all and welcome to my channel. So today I'm going to discuss the 6 takeaways that I got from J.L. Colin's book, The Simple Path to Wealth. This book, if you are a new investor, is so influential, so inspiring, and it will motivate anyone to start investing because the whole point of the book is to explain how simple it is to invest. So let me give you the 6 takeaways that I got from the book that could certainly help you on your path to building wealth. The first takeaway that I got from the book is investing is simple. Now, when you start investing, you're gonna see all this stuff out there that's gonna confuse you. You're not gonna understand the lingo. You're not gonna understand how to execute a trade. It's so much complication, and then you're gonna be afraid to do anything because it is a lot of information and it is very intimidating. But when it comes to investing, it is extremely quite simple. It's not as difficult as you think it is. And in the book, he explains it very well. There's only a few things you need to do when it comes to investing. Number 1 is to spend less than what you make. And whatever you have left over, that's the money you use to save. If you have debt, you pay it off, or to start investing in the stock market. And when it comes to the type of investments that you want to invest in, stocks is what I recommend, and it also recommends it in the book. But you do not need to pick it on the individual basis. What you could do is invest in mutual funds or ETFs or anything that follows the S&P index. So if you hear anything about investing in the index funds, just remember it's a fund with a whole bunch of other stocks within this fund that will allow you to invest into multiple companies and not have a lot of risk. The next takeaway that I got from the book is start early and be consistent. The earlier you start investing, it gives you more time for that money to compound because compound interest is your best friend. And this will continue to compound, especially if you start at an earlier age. Now, what do I mean when I say compounding? All compounding is, guys, is the money you have in your account and the interest you're earning is not only on the money you put in, it's also on the money that you actually started making within your account as well. And this is occurring daily. It's not yearly, it's not monthly, it's daily. So you can imagine the earlier you invest, the more money start making the interest, and your interest making interest off of interest, you will become extremely wealthy. Now, if you're someone that's not in your 20s and you're in your 30s and you had all this baller life in your 20s and now you're trying to figure everything out, it's okay no matter what age you start, guys. It could be in your 30s, it could be in your 40s. It's better to have something than nothing. So yes, you need to start early and be consistent, and you weren't doing that when you're a lot younger, but it doesn't matter. You still could start now and be consistent now. You might need to put more money than you needed to put when you were younger, but who cares? You still want to have something left in order for you to survive. And trust me, you will be amazed with how much money you can make even if you start later in the future. The third key takeaway is to live frugal, which a lot of people struggle with, and you might be one of them. Now, when people hear frugal, they'll automatically think of stuff like being cheap. It's not about being cheap, guys. It's about finding the best bargain. Let me give you an example. If you're booking a vacation, you want to pick the best time to go on that vacation. You don't want to pick just any random day and pay the price that they're telling you to pay, because air flights, hotels, there's so many things that could cause your price of your vacation to be cheaper if you are flexible within your dates. That's not being cheap. That's being smart, and that's being frugal. Now, being cheap is someone that just goes to Chick-fil-A stealing ketchup packets and they're living off Chick-fil-A ketchup packets. That's just being cheap, okay? Some could say frugal, but to me, that's cheap. I'm just talking about being smart, doing your research, and making sure the things you're investing in is giving you the best price. Whether it comes with clothing, vacation, your home insurance, your car insurance, everything in your life is negotiable. And you definitely need to build the muscle to negotiate. Because if you are in a situation now where you do not have so much income, you have to find ways to decrease your expenses, and you can take that difference to invest. Now, the more you do that now is the more money you can get in the future, and then you won't need to be as frugal. You can say yes to the things that you can afford, which will be a whole lot more than it is today. The fourth takeaway that I got from the book is to educate yourself on finance. You do not need to study about the history of stocks and get so sophisticated with doing margin calls and all these sophisticated exotic securities. You just need to educate yourself on the simple terms of finance. Now, you can subscribe to this channel, you can follow it. I'm going to give you a lot of videos on basic terms in finances to help you understand. I'm gradually going to increase to a point where it gets more sophisticated. That way you can hear this lingo and understand exactly what it is. But if you want, you also could start with Dave Ramsey. Now, a lot of people do not like Dave Ramsey, but if you are in depth, I highly recommend you listen to his show. And there's a few reasons. Number one, it gets you extremely motivated. If you follow a channel like Dave Ramsey, you get to hear other stories that people have that's very similar to yours, and you can understand there is a way to get out. So he can answer your questions about what you have about finance and the situation you're in simply by just listening to his show. You can get the podcast, you can listen to it live, you can listen to it on YouTube. There's so many ways to consume all that information that he's providing to you. So take advantage of it. And in this book, J.L. Collins explains that tremendously, that he made so many mistakes throughout his journey because he wasn't educated on certain aspects when it comes to finance. So someone like himself, and he doesn't really state how much money he has and what his net worth is, I'm gonna guess it's somewhere in the millions, is admitting that he made mistakes and he wished he could have done a lot differently when he was younger and when he was investing. But the point of all that is education, guys, is continual. You don't just learn about finance and you stop. It's always revolving and evolving, and you need to adapt with it if you want to get wealthy. The fifth tip I got was once you hit the 4% withdrawal rule, then you are considered financially free. Now, what do I mean by the 4% withdrawal rule? This is saying that once you have $1 million within your investments, you can withdraw 4% of that money, which equates to $40,000, and you have a 96% probability that that money would not run out. Now, there's a caveat to that. Of course, it depends on when you retire. If you decide to retire at the age of 40, that money can run out. But if you go to the typical age, 65 to 62, you can withdraw 4% of that $1 million and it would not run out. Now, $40,000 a year to some people might not be a lot, and that is just a way of letting you know how much money you need to have in your investments in order for you to retire safely. Let's say if you're someone that wants to retire with $100,000. With that being said, doing the math in my head real quick, that equates to $2.5 million. That is a safe way for you to be able to do a 4% withdrawal rate and have $100,000 in your account. So that is what keeps you financially free. Now remember, just because you are financially free doesn't mean you quit work. Financial freedom means you have the ability to do what you want, when you want, on your own terms, which is the number one goal so many people have when it comes to investing and living their life happy. You don't want to be tied to a 9-to-5 for the rest of your life because you made all these dumb mistakes and now you can't get out of it. Do you want to be able to save in order to give yourself some freedom to do the things that you want to do and not going to work and asking for personal days off and vacations and they're not going to give it to you? It's a hassle. If you love your job, continue to do it. If you don't, you need to build this wealth on the side in order for you to have the flexibility to leave. The sixth takeaway is index funds are one of your best, simplest options that you can choose and is cost effective. He is a big fan of Vanguard, specifically the FSTAX, which stands for Vanguard Total Stock Index Fund. Now, this is a fund that holds the stocks of all the companies within the market. So what he is saying is you just invest in this, you mind your business, you set it, and you forget it. And that is an option to me that will build you wealth, and it is safe. So many people try to beat out the market and they fail. And you might do it one year and you might not do it the following year. And it takes a lot of work in order for you to try to beat the market. When you buy index funds, it's just passive because all you're doing is you're just following what's in the market, that's it. And that usually equates to a cheaper expense ratio. Very cheap. Your expenses will be low. Now, this is where he became so famous, especially in the FIRE movement, because he highly recommended in a simple path to wealth, which is pumping all your money into that actual index fund and you will get wealthy. Guys, on average, the stock market has made 11% return. Now, some years is below 30, some years is above 20. It goes up and down, but on average, it comes up to 11%. So if you set it, you forget it, and you invest in index funds, you know you are safe. Because there's no possible way that all these companies within that fund, we're talking about Microsoft, we're talking about Facebook, we're talking about Amazon, are all going to crash. And if they do crash and you lose all your money, you have bigger problems than the fact of you lost all your money. So there you have it, guys. Those are the 6 takeaways that I got from that book that is really interesting and can definitely help you on your financial journey. Catch you guys in the next video. Peace.